Good morning, traders, and welcome to your Monday morning markets briefing. What a fascinating start to the week we have ahead of us. The markets are speaking volumes this morning, and as always, it's the geopolitical undercurrents that are driving the real action in our space. So let's dive straight into crude oil, where we're seeing Brent climb to $67.16 per barrel, up 0.7% in early trading this morning. This comes after 3 consecutive days of losses, but here's what's really moving the needle. Escalating tensions in Europe are reminding everyone just how fragile our energy security remains. Russian military aircraft breached Estonian airspace for 12 minutes on Friday, and over the weekend, Polish forces scrambled jets to protect their airspace after Russian strikes targeted Western Ukraine near the Polish border. So if you're trading in oil futures right now, think of doing tactical long positions on any further geopolitical escalation, particularly around the $66-67 resistance level. The market is clearly pricing in risk premiums again. Natural gas is presenting an interesting paradox this morning. While Henry Hub climbed 1.3% to $2.93 per MMBTU. The fundamentals remain bearish, with strong storage levels sitting 6% above seasonal averages. The EIA reported a massive 90 BCF build last week, well above the 5-year average of 74. If you're trading in natural gas, think of doing short positions on any weather-driven rallies, as production remains robust at 107.4 BCF per day, despite the slight pullback from August's record highs. Now let's talk about what's happening in the LNG space, because this is where the real story lies. The US LNG industry is facing what is being called the victim of success syndrome. We've reshaped global markets over the past decade, but now we're staring down the barrel of a potential oversupply situation coupled with rising domestic power prices. If you're trading in LNG-related plays, think of doing defensive positioning around supply chain bottlenecks and consider the margin compression that's coming. Moving to precious metals, gold hits $3,717 per ounce, up a solid 0.88% on the day, while silver absolutely exploded 1.36% to $43.67 per ounce. Silver's monthly performance is particularly striking at over 13% gains, and year to date we're looking at a phenomenal 42% rally. If you're trading in precious metals right now, think of doing momentum continuation strategies in silver, particularly around the $44 resistance level. The Fed's recent quarter point cut is providing the tailwind, but it's the geopolitical uncertainty that's really driving safe haven demand. Copper presents a more nuanced picture at $4.57 per pound, essentially flat with a marginal 0.06 gain. The industrial metal is caught between Chinese stimulus hopes and global growth concerns. If you're trading in copper, think of doing range-bound strategies between $4.50, $4.70 until we get clearer signals from Beijing on infrastructure spending. The grain markets are telling their own story today. We're seeing continued pressure in soybeans around $10.25 per bushel amid lingering US-China trade uncertainties. The market had anticipated concrete developments from recent diplomatic meetings, but the lack of substantial Chinese purchases is weighing on sentiment. If you're trading in soybeans right now, think of doing tactical short positions on any failed bounces above $10.40, as harvest pressure mounts and global supplies remain ample. Wheat futures are showing mixed signals, with Chicago wheat holding around $5.22 per bushel. The pro-farmer crop tour concluded with record-breaking yield projections, but European quality concerns due to excessive rainfall continue to provide some support. If you're trading wheat, think of doing spread strategies between Chicago and Kansas City contracts. capitalizing on quality differentials. Looking at the bigger picture, what we're seeing this morning is markets caught between competing narratives. On one hand, we have the Fed's dovish pivot providing liquidity support across commodities. On the other, we're dealing with geopolitical tensions that are creating genuine supply disruption risks, particularly in the energy markets. The dollar's relative stability is keeping a lid on broad commodity rallies, but the selective strength we're seeing in precious metals and energy suggests traders are positioning for uncertainty rather than growth. As we head into the rest of this trading week, keep your eyes on three key catalysts. First, any escalation in Eastern European tensions will drive energy premiums higher. Second, the upcoming PCE data on Friday could reshape Fed expectations and impact dollar-denominated commodities. Third, watch for any concrete developments on US-China trade discussions, particularly around agricultural purchases. The market is clearly in a risk assessment mode this morning, and for those of us who've been trading these markets for decades, this feels like one of those pivotal moments where positioning matters more than predictions. Stay nimble, stay informed, and remember, in commodities, it's not about being right. It's about being positioned correctly when the market moves. And that's your Monday market overview. Trade smart, trade safe, and I'll see you back next week for another deep dive into what's moving our global commodities landscape.